Mahesh Patil, Core Chief Investment Officer with Birla Sun Life Mutual Funds. He joins us live from his Mumbai studio office. Mahesh, good morning. Thank you for joining us. Mahesh, were you pricing in such a strong and a rosy scenario when we started the financial year FY14, or the strength and the speed of the rally has surprised you also?
Well, our view has been that this year you will see the markets the economic fundamentals bottoming out, and the market probably would be range bound, okay, with returns in line with the earnings growth. I mean, we also felt that the earnings trajectory now should come back to the long-term average growth rate, which has been around 12 to 13%. I mean, last 2 years we have seen earnings growth for corporate India in single digits, and essentially driven by bottoming out of growth. We see growth coming back slowly and steadily this year, and also interest rates coming off, so that should aid at the bottom line. So I think we were expecting a slightly moderate recovery this fiscal year, but I think the expectations of rate cuts, I think in the last couple of days have accelerated because of the steep fall in inflation, and that's the reason why you've seen such a sharp rally in the couple of days.
Mahesh, hi, morning. So what is it that you are expecting from the RBI, and more importantly, the quantum of the rate cut that is going to come about this time?
Well, our view has been that by the end of the year, you will see around 175 to 100 basis point kind of a rate cut. We expect, we had come out with a note recently, just a few days back. We expected bond yields to 10-year bond yields to G-Secs to come down to around 7%, and that's happening pretty fast. And I think the more important thing is to see how this transmission happened to the corporate India, because we haven't seen the earlier rate cuts translating into lowering of the borrowing cost for corporates. But I think incrementally, I think we should see that benefit coming into the corporates, and that should really help revive the economy. And more importantly, I think even on the discretionary consumption, I think as interest rates go down, we should see a revival over there, which has been impacted in the last 1 year.
Mahesh, do you think the recent leg of the rally, which started from 15th or 16th of April, has got nothing to do with local fundamentals? In fact, locally policy risks have only increased. Parliament, no important bills were passed. Do you think the current leg of the rally is largely global in nature? Global equity markets are in a strong uptrend, and that is benefiting a market like India?
Well, I think to a large extent I would say that, because what the market does in the shorter term is to a large extent driven by liquidity and flows. I think that has been supportive. You've seen a rally across global markets, risk on kind of a trade, and that has also, India has also participated in that. But having said that, I think while it might be right to say that we haven't seen any dramatic improvement in the fundamentals, but the fact is that a lot of the negatives have getting priced in. So at the margin, we have seen improvement slowly and steady, nothing dramatic in the macroeconomic fundamentals, and that's supportive from a medium to long-term perspective. I think near-term rally, I think, is to a large extent driven by global liquidity, I would say.
So if you expect that this year equities will move in line with earning estimates, and earnings according to Bloomberg estimate for FY14 is in the range of about 12 to 14%, do you think bulk of the, or at least 50% of the rally is already in the price?
I think very difficult to say how the market movements would be in the near term, but yeah, I think from a fundamental standpoint, I think looking at the earnings growth rate, our view also had been that you would see similar kind of a return from a 1 year perspective. And mind you, there are also headwinds as we move forward in terms of elections, in terms of a lot of noise around government trying to go into appease the voters. So I think that those are something which one should be aware of. But I think if you take a slightly medium to long-term view, which we have been talking about for quite some time, I think the base is being created now for the market for a longer-term rally, because, as I said, all the other indicators are indicating that we should see a sustainable recovery for the market over the next 3 years or so, as we see recovery starting from the bottom, what we hit in the last quarter, and even earnings trajectory shaping up. And hopefully post-elections, you would see some kind of stability, and even the investments climate, which has actually got impacted, I think that should slowly start picking up. So I think we remain structurally positive on the market from a medium to long term perspective.
Mahesh, has retail money come in at all in the last fortnight or so, or has it been just a purely FII driven rally?
See, retail money, one positive what we have seen is at least the outflows, okay, have kind of moderated quite a bit. So on a net basis, I think we are probably just about there. We haven't seen any net big inflows coming in. We saw good inflows coming in the month of March or April. But my sense is that retail money will take some time to come in as they see the markets kind of sustaining at higher levels. I think slowly and steadily you will see. I think a lot of money also has moved into the debt side and the bond market. I think as that rotation happens across asset classes, I think we should see retail money coming in. Even as a lot of savings have moved into, as we know, into gold and real estate. And as these asset classes start to underperform, I think we remain positive that you should see retail flows coming in somewhere the latter part of this fiscal year.
Do you think the quality end of the market will continue to do well? And are you happy to pay a premium to quality stocks?
I think quality will continue to do reasonably well. I think that's what I think we have seen in the last few years. But I think beyond a point, I think valuations will start to really look into it. One should see that a lot of stocks are at valuations which are way above their long-term average, probably one standard deviation above that. Slowly and steadily as we see risk taking coming back as interest rates go down, I think some of the beaten down sectors, especially the rate sensitive, the cyclicals, where the valuations are also at their all-time low and where the trajectory could be where you could see some kind of a turnaround. I think those are sectors, okay, which could probably outperform if you take a slightly medium-term view.
Do you make any stock changes in your portfolio in last 3 months? Because last time when we interacted, you had loaded up banks, you were neutral on IT, and you were considering to buy into some industrials.
Yeah, so I think our view again was we were trying to position to some extent to look at the recovery and to also play the rate sensitives. So I think we've taken that position, we continue to hold on to it. And no, we haven't really done any aggressive changes in our portfolio recently.
What do you mind, Mahesh, would underperform from here onwards? While there is a whole lot of talk about, the entire rate-sensitive basket moving, we've seen the way the Bank Nifty has been performing, infrastructure as well has looked good. But what do you think is going to underperform going forward?
Again, I think difficult to really answer, but I think we have been a view that a lot of the consumer space, though we have seen this sector really outperforming hugely, looking at the valuations and the fact that also growth has slowed down over there. So the risk reward seems to be unfavorable. So I think the consumer space is where we are underweight at this point in time. And to some extent global cyclicals, while we have seen a global rally in the market, I think the global economy is still under stress and China slowing down. So we expect the global cyclicals to underperform.
Mahesh, do you think it will be a while before industrials will make a comeback? Because I know the underlying thesis is that Indian economy will recover, rates will come back, and the private sector capex will start. But for this script to pan out, I guess we need a stable government in place. Corporate India is unlikely to invest till the time they don't know who will rule the next government.
Yeah, I would tend to agree on that. Yeah, so typically the industrials would be a late cyclicals. You will see first interest rates going down and discretionary consumption start to pick up, and capex would take some time because there are still structural issues, okay, which are their business confidence is still low. A lot of projects are still stuck, okay, and unless those get cleared, I think promoters won't have the courage to really invest into new capex. So we would not expect any meaningful recovery in the industrial at this point in time. So clearly, I think where we see really things panning out is more on the discretionary consumption, because as interest rates go down, I think that should really help, and we expect some kind of infusion in the economy, because as we move towards the election, a lot of spending happens and a lot of money flows in the hand of the consumer. and that could fuel demand for consumer goods.
Mahesh, good chatting with you. Appreciate you taking the time out and joining us on ET Now.